Welcome back to the program. I'm Zev Brenner with us once again. Michael Zaremsky, head of U.S. Private Banking, Bank Luma USA, member of the Investment Committee for Luma Investment Services. You're listening to the Luma Financial Corner. Michael, good to have you back again.
Great to be back, Zev. Thank you very much, and hope all is well.
Thank God. We're in the summer. I shouldn't call it doldrums, but there's a lot happening, especially politically. There's always some new excitement, and also with the variations of COVID. But how are the financial markets doing this time of year?
Well, Zev, before I answer the question, I'd just like to remind everybody that the views expressed are my views, not necessarily those of the bank or the broker-dealer. And I think the challenge that we have right now, again, we have a news cycle that's 24/7. We have a lot of things to fill the air. As you said, there's a lot of noise on the political fronts, whether it's what we're seeing locally in New York City, New York State, or in Washington, D.C., with a lot of the discussions around the infrastructure and other spending plans. But ultimately, a lot of the pillars of what we talked about for economic recovery appear to be consistent, appear to be holding, and appear to be in place. Fiscal policy remains supportive and accommodative. There's a lot of money slushing around the system. And when we look at the central bank, again, the central bank has remained resolute in providing accommodation that's juicing the economy. You did mention the Delta variant of COVID, which again is becoming a very big news story, and to be determined whether or not it's going to have legs in terms of economic impact. The whole point of the vaccinations was to prevent significant illness, sickness, hospitalization, and death. And as the news continues to report, it seems that most of the people, or most of the impact of the Delta variation, is from people who are not vaccinated, and that the vaccinated people seem to be doing okay through it. So if that's the case, it becomes something we can live with rather than something that we need to shut down from. And I find it difficult to believe that there will be a lot of tolerance for lockdowns or continuation of the policies we've seen over the last 18 months. So when we look at that and we look at a backdrop that's relatively stable, the question becomes kind of, what do you do when nothing's really changing? And ultimately you kind of go back and look at science and the whole concept of inertia, and that's that objects in motion tend to stay in motion unless they're acted upon by some other force. And when I think about the main inertia right now, it's just the continuing grinding higher of the equity markets. That remains supported by economic activity. Economic data continues to be healthy. In some cases, a little bit under expectation, a little bit over expectation, but still generally positive. The GDP numbers recently came in a little bit lighter than expected, but still very, very healthy at basically 6.5%. We'll see how the job data continues to move, but as the Fed has noted, a lot of the issues that we're facing are transitory. They're related to supply chain. They really need to work themselves out before the Fed takes any significant action or moves in any direction on tapering or interest rates. So for the foreseeable future, we continue to be in this moment of momentum. And as I said, on the equity side, it's upward momentum. In the yield market for fixed income, that momentum seems to be negative. One of the stories that seems to be gaining some traction right now is that there's a lot of foreign buyers coming in and buying U.S. fixed income product, particularly from Europe and Asia. The Fed right now has pretty much cornered the market on securities. They own about 35% of government fixed income securities. It's difficult to really say what a free trading market is doing when so much of it is being held and manipulated by the Fed. And as unattractive as many Americans will believe rates on the 10-year, at 110, 115 to be, the German 10-year is making new, recent lows. And bond markets across most of the globe are very, very unattractive. What I would also say politically, there's a lot of noise out of China right now. And when people think about where the other investment alternatives, emerging markets in China have often been an area where people talk about high levels of growth. As a public investor, I think a lot of light has been shed on what you really own when you own Chinese securities. There's a Chinese law that prohibits the outright ownership of securities by foreigners. And we've been introduced to the concept of how Chinese issuance have been used to kind of circumvent that, but you really don't own shares. So I think that there's been a big wobble in the market on trust and confidence in the Chinese model. And I think that that's probably something that also adds to some concern, adds to some risk factors, and moves assets back to the United States, which in the form of equity markets help the momentum, upward momentum of equity, and in the case of the bond market, help that downward momentum of yield. So, that's kind of how I think we see things stack up right now. And as we've talked about in the past, and as we'll continue to see as we get data for later this month into September and into October, we're probably largely in a holding pattern until late third quarter, early fourth quarter. And, the general view would be, as I said, objects in motion continue to stay in motion unless they're acted upon by, another force. And it's tough to really see what those forces are right now that will change current momentum in markets.
So we're really in a holding pattern for at least another month or two.
That's what it would seem to be. Again, the markets have a pretty good way of humbling everybody. And as I've always said, shocks can come from where you don't see them. We could definitely see a situation where there's a scare in the market for one reason or another. I always reserve the right to say that it would never shock me in any way, shape, or form if we saw a 5 to 10% correction in equity markets. Not my base case, and also something I'm not really worried about, because I think markets right now with all the liquidity will correct. If they do correct, they'll rebound rather quickly. And we keep hearing a lot of negative stories as equity markets keep making all-time highs. So again, the S&P 500 recently posted another high. It seems that everything is trading within a couple of percentage points, and it seems tough to keep a good market down. So yeah, largely speaking, I think we continue to look at some clear sailing ahead as we continue to grind higher and continue to eke out returns. Particularly on the as we're on the midst of really going through an earnings season that again is showing quite powerful earnings numbers for corporate America, and stocks are becoming a lot less expensive as companies' earnings are kind of justifying the multiples that they've been trading at.
So I guess it's good news if the holding pattern, so we've got to wait and see what's going on. So Michael Zaremsky, head of U.S. Private Banking, Bank Leumi USA, member investment committee for Leumi Investment Services. Thank you for giving us some insight as to where we're holding at the present time.
Thank you very much, Zeb, and look forward to talking to you again soon.
And you've been listening to the Leumi Financial Corner. We'll be right back.